All right, welcome everybody. I want to wish everyone happy holidays, all good things in the new year as we look ahead to 26. Before we jump into the forecast and the AI super boom, fueling the bull, the 6th year of the presidency, just run through a little history for the uninitiated. We've been around for 60 years. I'm going to be 60 in May. My illustrious father started this Stock Traders Almanac back in 66, the year I was born. You can see the original 68 edition that came out in 1967. Yale lived to the ripe old age of 98 before passing in the fall of 21. Basically, back in 66, I was born, bred, weaned, raised on market cycles, seasonalities, patterns, and trends. So the other books we've put out there, the Almanac Investor, still in print out there. That's a lot of seasonal sector trading. Yale's Don't Sell Stocks on Monday, great title. He was an old songwriter, had a way with words, could coin a phrase. You may have heard a couple of them, like if Santa Claus should fail to call, bears may come to Broad Wall. That was him. The Super Boom forecast. This is something that a cycle that Yale discovered in 76. He was looking for 500% moves in the market after war and inflation. We put another. We noticed this cycle coming into play after the great financial crisis, and put this forecast out, another 500% move. We've reached that. We've upped the outlook. We think this AI, technological innovation is part of that super boom, along with the inflation, the COVID spending, a bit like the wartime spending that Yale noticed after World War I, II, and Vietnam. The little book of market cycles, kind of the sort of little book for, sophisticated book for dummies and all the cycles. It's a great read. It's still out there, and all the places we get to humbly appear and get picked up. Again, it was a hit right away. We wouldn't be here for 59, going on 60 years if it wasn't still valid and working. It's been called the most influential book on Wall Street. It's still on the desks of top traders, managers, advisors. It's it's still a hard copy. You can write notes in there, but it really gives you a good reference. I keep one on my desk, of course, along with the most recent years. We've sold over 1.5 million copies over the years. As I said, Yale created the first edition back in 68. He invented the Santa Claus rally, the January barometer, the best 6-month switching strategy. He put the 4-year cycle on the map. He coined the term October phobia. And as I said before, if Santa Claus should fail to call, bears may come to Broad Wall. I like to say, forget sell in May and buy in October and get your portfolio sober. My philosophy is sort of a take off of the old Santayana quote that those who fail to remember the past are condemned to repeat it. I like to think those who understand market history are bound to profit from it. Our process over the past 60 years, we've been analyzing, researching, and testing pretty much every stock market trend imaginable. Happy to take some input from readers, as we always do. We publish those findings annually in the book, the Almanac, and we update weekly and monthly in the Almanac Investor newsletter. We use all this information to construct portfolio, our basis, our foundation to cycles and seasonals and history, but we also look at technical and fundamental analysis, market internals and sentiment, monetary and geopolitics, current trends in the economy. So that's the history. Today, we offer you our best price available, the holiday special seasonal offer. You get a free copy of the Almanac with every subscription. There's a code up there, a QR code you can use. It's $169 for a year. You're never going to find this low at any other time of the year. $289 for 2 years. Again, you get a free book every year, shipped to you early before everybody else. So if you want, you can go to stocktradersalmanac.com, hit the get the STA for free link, or just hit that QR code and take advantage of this offer. So for today, we're going to talk about whether there will be a Santa Claus rally this year. I'll just tell you, I think there will be. I think it's setting up. This current rally we're seeing right now is not yet the Santa Claus rally. That starts tomorrow after today's close. I think we can still get to 7,100 S&P by year end. It's it's part of our best case scenario for the forecast we put out last year around this time. That would be another 20% gain for the year. That would be, 4 in a row. The bullish post-election year patterns are on track. The best case scenario is a little harder to reach, but I think we can get there. I think we're about 3.2, a little bit less, a little bit closer today with today's close. Yesterday's close, we're 3.2% away from 7,100. Again, the forecast for next year, the basic is 8 to 12%, a bullish 6th year of the presidency, where the second midterm year is all about these presidents sort of securing, solidifying their legacy. It'll be important for us to hit the January indicator trifecta, and we'll talk about it a little bit. You know, the AI super boom still in play, and we got a little bonus update at the end. So we'll look at some of the commodities, seasonals, and Bitcoin, and some technicals there as well. We got the midterm year patterns for the commodities too, a good string of them. So jumping into the forecast. This is last year's where we're at right now. The best case is still on track. The 20% gain for this year, we need to Santa Claus rally to get there. It will have to be, you know, 3% or so one, depending upon exactly where the dust settled before, you know, just as we started up today here. We started out last year with, you know, base case scenario with a 65% probability with 8 to 12%, with some, you know, typical early post-election year behavior. And our best case scenario was at 25, but once we came off the tariff tumble and broke through some of the resistance levels, and the market started behaving very well and tracking the best, you know, most bullish post-election year seasonal patterns, we upped it and made the best case about 70% and kind of just tracked along the year. Right now, as I said, S&P is up 16.9% for 2025 as of yesterday's close. We tapped down a little bit more today. I think we might have been at a new all-time high. If we when I started up, we were above the high level. So again, about 3% to get to 7,100, which would be a 20% move. Just want to show you the current post-election year pattern. This is this year in the red line. I've got my little pointer here. You see the tariff tumble. Kind of felt like a little bit like almost a bear market, kind of a reset. It wasn't an official bear market, but you know, we could argue that we're in a new bull market, or the going into the 4th year of the old one. But you can see this green line. Since 1985, post-election years have been the best year of the 4-year cycle. And we've got our aggregate cycle in this pink line, which is all years since 1949, all post-election years, and all 5th years of the decade, which we're going to get into a little bit more of the decennial pattern as well. But I mean, it's kind of hard to deny once we get it through the summer. And, you know, granted, we just traded very well. This was, you know, a reset, VIX at 60, you know, you got to buy that. But once we start tracking this green line up here, looking like we could probably even do better. And, you know, we're right back on it. Santa Claus rally will help push us up to 20%. Or if we don't get exactly there, we're pretty close. So answer the question, will Santa Claus deliver? I think so. It's looking set up. And I'll tell you why. The December seasonal rally, you know, seasonality is back on track. We had the sell and May period, the worst 6 months of the year from May through October were pretty darn good. We had new highs, a whole bunch of them in September and October. Then we had a November sell-off. There was some triggers from the crypto world and Mr. Powell's comments on the FOMC meeting on the 29th knocked the stock market down. But looking here, everyone gets you know, into the Santa Claus rally, year-end rally mode a bit early. I was talking to a trader friend today about that, and I forget that, you know, the first half of December tends to be choppy. There's a lot of tax loss selling. You hear people talking about that, you know, all the, you know, pundits on TV these days. But this is true. We've been tracking this for years, and in the dotted line is this year. We got the post-election year pattern going back to 1950 here. But what we can see is that it's a very typical soft open for December. We get this rally right here around mid-month, the mid-December low. It's happening again, and this sets up the Santa Claus rally. So we got a seasonal turn in December right on cue, seasonality back on track, and perhaps that can put the best 3 months of the year, best consecutive 3 months, November, December, and January, back in the black, or at least in the way up there in the black. It's behind right now. You can see that historically, going back to 1950, 71 for NASDAQ. We've got 4.4% gains for S&P and Dow, and about 6.2 for NASDAQ. As of yesterday's close, Dow was up 1.7, S&P was up about 0.6, and NASDAQ was still off 1.25. Yesterday's close was where that was. We tapped on a little bit more today. So if we can get positive in December, we can get a decent January. Best 3 months can pull through. So in our forecast issue, the full 2026 forecast issue went out to subscribers. We went very deep into our 4 horsemen of the economy: the Dow, consumer sentiment, which is an issue. We talked about the disconnect between consumer sentiment and consumer spending. There's inflation in there. We have a exponential moving average of the CPI and PPI, as well as unemployment. But we're not going to get into all that here today. But the Q3 GDP came in pretty strong. It was at 4.3% today. I know it was delayed by the government shutdown, but can't complain. Still pretty positive. The Atlanta Fed number here, the first estimate as of I guess it was today's the 23rd update, 3.0 for the fourth quarter. Pretty solid. I mean, there's going to be some questions about the data with the shutdown, but I have to laugh. People are skeptical of the government data. We've been skeptical of government data for a while. I'm skeptical of most data in this business. There's a whole chapter in the Superboom book about how they manipulate inflation to mask it and to keep the cost of living increases down. But that's another story. So growth looks pretty good. I'm not sure what all the sentiment issues are with the University of Michigan and the Con number, but I don't know, the malls look pretty busy. Consumer spending's pretty robust. So people might be saying they're nervous, but they're sure pulling out their wallets and shopping and spending things. Holiday season is, I guess, one for the record books, at least slightly higher than last year, and $1 trillion for the holiday sales or the Black Friday, Cyber Monday. But unemployment, we think these concerns are a little bit seasonal. We like to shift, into the initial claims. It's much harder to manipulate this number, and it's really just a raw data. This is not seasonally adjusted. So this little recent spike that everyone got a little worried about or concerned with was pretty seasonal. We see it coming back down like it has all these other years around this time. Something to keep our eye on. If it does, jump above, it would be a warning sign. But claims are pretty normal, not crazy. There's also a lot of a increase in participation. Unemployment rate may be ticking up a little bit, but there's also a lot more people looking for jobs. So again, it's definitely something to keep our eyes on, and the Fed should be keeping its eye on as well. But inflation is another issue. Here's our chart right off the Fed database of CPI, PPI, and the PCE. Data is definitely delayed here, but the September PCE did tick up. Inflation metrics appear to be trending higher. I don't know about you, but everything's more expensive. Holiday roasts are going to be a little bit more this year. I know my strip steaks have gone up a bit. But this wishful 2% target is something that we've questioned for a long time. I don't think it's happening. Yeah, maybe they got a 2 handle on the PCE, but our long-term historical analysis shows inflation averages about 3%, CPI based. And I think that's something that we're going to have to, live with. I think the Fed also, perhaps a new Fed will be, refreshing. I think they need to go back to the old days of being less vocal. They need to stop making so many speeches and analyze the data, and go back to being the guardrails on the bond market that they were set up to be, and not try to dictate policy as much, and just respond to the much smarter bond market, and when things change, to go in there and make some adjustments as they should to respond to what happens in the capital markets, the bond markets, in my humble opinion. Little confusion with interest rates. Doesn't look like we're going to get a cut in. This is the CME, the Fed watch over here in January. Probably get a couple in 26. You can see this interest rate chart. We've got the 30-year in the black line up here, along with the 10-year. This is off of Stock Charts, one of our friends. You can see we've sort of gone sideways here since the cutting cycle this fall, and rallying up a little bit. The wider yield curve is encouraging. The steepening there, that's bullish. The concerns with the debt levels and the trade wars, the trade wars might be alleviated. I think some of that's going to come home to roost next year. We'll see how that works with inflation. But again, the Fed needs to just stop jabber-jawing about everything and respond to the bond market and the data. Looks like we're sort of getting close to the end of the recent cuts, but we're still in an easing cycle, and they are concerned about jobs. So just to look at one of our other disciplines is sentiment. We like to look at the investors intelligence number. We are rated in here, but this isn't just your typical survey. This is what people who are getting paid to give their analysis are saying in their publications. So we have these bullish sentiment got pretty steep. We had a little bit of pullback there, and what we are seeing potentially bullish sentiment. This is the difference between the bulls and the bears. Can stay pretty high as the market rallies. I think we might be in a situation like that at least through the first part of next year before we get a little sideways action during the Q2, Q3 weak spot of the 4-year cycle, which I'll get into. But bullish sentiment is not necessarily the end. It's usually when you see these spikes lower that you get a lot of bears, very few bulls where you see a low point. But the upper end of the frothy bullish sentiment can go on for quite some time. So getting into the forecast now, we think the 6th year of presidency is it's all about legacy, the second midterm year. In the forecast issue, we've got a full updated version of the 4-year presidential election cycle chart covering all years from 49 to 24 compared to the current cycle so far, which is 25. We think that short-lived, steep, tariff-driven correction early this year gave off a bit of a bearish vibe, and while not an official bear market, does seem to have reset the market, putting us in sort of a quasi-new bull. And it likely, pulled some of the usual midterm bearish action forward, suggesting that 2026 weakness could be mild. The midterm year market clearly shrugged off many of the headwinds, and definitely tracked the more bullish seasonal trend of the post-election years since 1985. So our best case scenario, 70% probability. Likely some more volatility. Probably the greatest in the worst 6 months of Q3, late Q26 rally, and Q4 will push us to in line with the historic 6-year of presidential administration's gains. 8 to 12% is what we're looking for 2026. The AI fueled spending and development of the super boom continues. Base case, kind of a more typical, the best case scenario would be everything just kicks in. They cement he cements his legacy, and we get another 20% year. AI market kicks in, labor market firms, everything just fires up. The worst case scenario, we give a 20% probability, an old school, ugly midterm year, mild bear market, teetering on recession, negative flat performance with broad losses. Most likely we'll be in the 8 to 12, and we'll look towards our early January indicator trifecta Santa Claus rally, which is starting tomorrow, ends on January 5th, full month January barometer, as well as the first 5 days. So let's just look at the chart. This is off of page 10, slightly tweaked, of the 2026 Stock Traders Almanac. So many market pundits have been commenting on how difficult the midterm election years have been for the markets that we think it's unlikely that it will be anywhere near as bad as the doomsayers warn. While it's true that midterm years are the worst of the 4-year cycle, it's not the case for the second midterm year, especially second-term Republicans. So this chart, all midterm years down on the blue line here, about 4%, with a weaker, second Q2 and Q3, second and third quarter. The aggregate cycle, again, all years, the midterm year and the 6th year of the decade here, versus the green, second midterm Republicans, second Republican midterm years, and the 6th year of the presidents. All second-term presidents, their second midterm year. This is clearly where we get the 8 to 12 as our base case scenario, 70%. So I think a lot of folks are a bit too focused on the 4-year cycle. We had a real textbook bear market bottom in 2022 in October. The 4-year cycle helped us call that, but the Fed's also easing. We think we're at the early innings of the AI tech super boom. So again, while many folks are concerned about next year, we're pretty bullish, though less bullish than we were this year, and expect some more volatility, especially in the weaker summer months. So we just want to break this down a little bit, show you a few other things here. This is midterm election year seasonal patterns only, just the midterm years, but for the 4 main indices. Again, all years, you can see, so that soft patch kind of runs into the summer months, usually the third quarter mostly. This is when the campaigning really heats up, the mud starts getting slung, and the mud starts being slung. And this current administration, this current president, President Trump, has shown an affinity for getting involved in congressional elections. So that could take away from some of the other more bullish fiscal economic activity as they're trotting around the country and campaigning for other candidates. And there's pretty thin margins in the Congress right now. They're going to be pushing pretty hard to maintain for the Republicans to maintain those thin margins. Noting the notorious loss of of seats in the midterm year for the party in power. This is the 6th years of the presidential term. You can see it's much more bullish. A few less years for NASDAQ and Russell. That will, throw things off a bit. But generally, up in that, low double digit range. And then the 10-year cycle, which I know a lot of folks are starting to get focused on, again, gets us in the, low double digits for that 6th year of the decade. There hasn't been a loss in the last 5 6th years of the decade. There's a whole page on that in the back of the Stock Traders Almanac. It's up there every year. So with that sort of bullish vibration from the 6th year of the presidency, the 6th year of the decennial cycle, and Fed easing, as well as the AI boom, it comes down to, for us, the January indicator trifecta. Many people are talking about the Santa Claus rally. People are starting to get it. We spent a lot of time correcting people. It's the last 5 trading days of the year and the first 2 of the new year. People have been talking about it since, September, October, Halloween. You can see it was invented by Yale Hirsch back in '72. Here is a copy or a shot of the table of contents of the 1973 Stock Traders Almanac. I think I was about 6 at the time when this came out in the fall of '72. Here's the extraordinary January barometer on page 11, the Santa Claus rally on page 111. As he said way back in the day, if Santa Claus should fail to call, bears may come, not definitely, they may come to broaden wall. And as the S&P goes in January, so goes the year. The Santa Claus rally is the first leg of our January indicator trifecta. Everyone, a lot of folks are trying to trade it. Yeah, you can trade the year-end rally. That's one thing. But the Santa Claus rally is an indicator, and it's important if it doesn't come. You can see here, it's not perfect, okay? Sometimes we don't get a rally and we have a boom happening. Sometimes we get a rally and we get, a no Santa Claus rally, and we get a little sell-off like a tariff tumble. We'll get a flat year. Sometimes we get a bear year, but 2000, 2008, we're flagged by Santa Claus rally not existing. But it's a time to look deeper when it doesn't happen. When we get all three positive, it's great. But when one of them or more of them are negative, it's time to look at other indicators. When the market doesn't rally as it's supposed to as it usually does during this time frame, and this is page 118 from the current stock traders almanac, it often foreshadows weaker performance in the coming months or the year ahead, and it sort of exposes that there's some other issues going on, that the traders who are usually at the desks buying up oversold, tax loss sold stocks, that they're concerned about something. So the January barometer, just a quick rundown here. I don't want to, take too much time here, but this is the comparison of all monthly barometers. Again, the slides will be available. You can dive into this. We've analyzed this, in the newsletter as well. But basically, as January goes, so goes the year. There's only been 12 major errors since 1950 for an 84% accuracy ratio. If you include the 8 flat years, which are years that the market was up or down plus or minus 5%, it's still 73% or 733 batting average. It's pretty good. And the reason it works is the lame duck amendment, the Constitution that moved newly elected senators and Congress people into office the January after the November election, as opposed to 13 months later in the following December, when they all had to come back to Washington through horse and buggy back in the old days. It also moved Inauguration Day from March 4th to January 20th. We used to get the State of the Union in January, which really helped, get an idea of what the general policy initiatives and the direction of the country was going to be. But lo and behold, it's still pretty strong. And what we found is there's also this first 5 days early warning indicator. That's on page 16 in the almanac as well. So I gotta move this slide here. Sorry about that. The mouse is sticking there. So the most important thing from page 20 of the almanac is that bulls win when the market hits this January indicator trifecta. Santa Claus rally, again, last 5 plus first 2 trading days of the year, the first 5 days early warning indicator, and the January barometer. When all 3 are up, the S&P 500 is up 90.6% of the time, 29 to 32 years, for an average gain for the year of 17.7%. And it's 87.5% up 87.5% of the time, 28 of 32 years, for the subsequent 11 months, February to December, with a 12.6% average gain. So even not including January, it's still pretty strong numbers for the year, or at least pretty solid, again, at the upper end of our forecast. So if we hit this trifecta, it'll confirm our bullish outlook. If some of them are low or don't come in, or 1 or 2 of them don't, or all of them, we'll reserve the right to adjust our outlook and dig into some of the other indications, economic, technical, otherwise, macro, monetary, everything we look at. So with that, let's just recap the forecast. Hitting the trifecta is important for us to continue this AI super boom fueled 6th year of the presidency bull market. Some headwinds: the tariffs, the uncertainty from Trump 2.0. There's still some issues with geopolitics. Things are pretty quiet in the Middle East right now. Russia and Ukraine, remains to be seen there, but it's not quite as much of a drain. China's always an issue. Inflation's rising, at least a bit. Is labor softening? Remains to be seen. We'll get some better numbers once the government gets over the shutdown delays. There's some concerns with the ACA, Obamacare. We had a weak bullish season, even though we're starting to turn this, seasonally mid-December, and the crypto, Bitcoin deleveraging and lack of a bullish season there, which I'm going to get into in a second, is a concern. The tailwinds behind us, the super boom, the AI tech, disruption, the 6 year of the presidency strength, the Fed easing, perhaps the new Fed. Economy looks pretty steady. The GDP numbers were good today. The outlook for Q4 looks all right as well. Calm in the Mideast, as I said. Government spending still robust. The deregulation and tax cuts should be helpful to everyone next year as well. So my outlook is that we are going to get a Santa Claus rally, which starts tomorrow, and it should push us up to 7,100. Again, that's about 3% or so. For the year end, another 20% year. We expect a couple more rate cuts in 26. Steady economy, stable job market, 8 to 12% gain in 2026 for the year. That's full year gain, and that the AI super boom continues into 26 and beyond. There's also a little bit of an update on the super boom in my outlook in the 26 Almanac, which calls for further gains up to about 62,000 and change. So I'm going to give you some bonus info in a second on Bitcoin and commodities from my recent members webinar. But just so if you want to take a chance to become a member today, use the best price of the year. Here's the QR code and the Santa Claus rally code for the best deal. $169 for 1 year, $289 for 2 years. You get 2 free almanacs. You get a free almanac every year. You're a subscriber. 26s are here. We'll send them out. You get the 27 early next year, probably September, October, at least before Thanksgiving, as long as the mail's not on strike or something like that. So take advantage of this if you're interested. And let's look at Bitcoin. Here's a little technical chart. You can see Bitcoin's crumbled here. Maybe it's finding a little support. I'm not convinced. I think it's got to come back here to the April lows. We're out of our Bitcoin position. We had it for a seasonal trade using the iBit, the iShares Bitcoin Trust. I own some. We got stopped out. It was a bust. The Q4 year-end seasonal rally did not materialize. Crypto sentiment has soured. I'm not convinced this is the time. It's also weak in post-election, in midterm years. I'll show you that in a second. And seasonally, we did a study with the crypto burb, our friend Adrian Zdunchik over in Poland. He's quite a crypto guy and a technician as well. But this is my seasonal study. Again, the data is not as much as I'd like for a seasonal study. We have 2 different scales here, all years on the left side. That's the black line. I mean, the 800% moves, just kind of crazy. But the green line is on the right side, along with the current year orange line. This is since the CME futures began trading in the fall. It was December 2017, if memory serves. So we got 2018 through 24. This is like the September low. The old all years had an October low. We didn't get any of that. October 10, when there was a little tariff tiff with China and the U.S., there was an auto deleveraging that happened that just kind of took the whole sentiment, out of Bitcoin, and I think it's got some lower to go. Or I'm not convinced it's rallying. So no Q4 rally. We're out of that. And then here's the midterm year. You can't really do a chart with it because there's only 3 of them. The first year, 2010, was only a half year. The data we have goes back to July. You can see it right here, July 2016, 2010. But 50+% losses in the midterm years. We're a little negative here when we put this together, last month. Still about the same price, so it doesn't really matter. Maybe some of the negativity from midterm years pulled forward a bit, but you know, 3-0. I mean, maybe it's a record meant to be broken, but it doesn't bode well for crypto and Bitcoin. You know, some of the bigger sell-offs, the whole initial cycle for Bitcoin sell-off from 2010 to 2013 was down 93%. The second one was down from in 2017 down to 86, 87%. There was a 75% drop from 21, and here, you know, 25, we're down 30% or so from the high. Maybe we'll get down even more. Again, not our favorite right now. Copper, however, is. I own the miners, the COPX, one of our seasonal recommendations. AI, autos, housing, that demand's not going to be going away. Might be muted by some of the recent volatility, but this trade's doing well for us. It's basically, you know, totally recovered pretty much from the tariff hit back in April. The seasonal trade for us begins in December. We're in this in the newsletter. I'm in it myself. Usually runs till about April, May. I'll give you a look at the seasonal, midterm seasonal pattern here. Again, here's the 6-year pretty strong up through that seasonal period. You can see it's a little more pronounced and a bit weaker going into the latter part of the year. Gold making new highs. We had a purely seasonal trade on this. We closed out of it just at the recent December seasonal strength. If you still have it, you could take some profits. You could use a trailing stop. Still some additional upside, but seasonal fourth quarter gold trade, which we got into in the summer, worked pretty well. We also had the miners, the GDX and GDXJ. They hit our target prices up about 20% in a couple months, so we're out of those. You know, longer term inflation is there. The weaker dollar, global central banks demand is there, so it's likely to continue to support gold. Midterm seasonal trade still looks pretty bullish in the 6th year of the presidency, and you know, kind of flatter through most years. But again, here's that summer fourth quarter, you know, end of summer fourth quarter trade that we like to get into seasonally. Silver just going vertical. No position for us. Similar, you know, move with gold. Finally catching up. If we had a position, we began winding. It actually ran away from us a little bit. But you might want to again put a trailing stop in, take some profits. Finally got the new high, but could be wrapping up with the seasonal trade. Again, long term, expect silver to track gold. Here's the seasonal trend. You know, rallies pretty strong into you know, middle of the early part of the Q1, and then, you know, softer latter part of the year. So crude seeking a new low. Seasonally, we get into the energy stocks, the XLE, XES. We got into those. I got into them myself in the newsletter. But you know, the war could be ending soon. There's still a lot of supply out there. Looking for that December seasonal low coming in. But the Trump administration wants lower prices, seems to be getting at, and they keep putting pressure on it. It seems to be keeping a cap on the price. A lot of forecasts for 26 calling for even lower prices as supply remains ample and demand slows. We could see, you know, a 40-ish number in 26, but we have a seasonal trade in on this, and we'll be watching that closely. Seasonal pattern for the midterm year and all years. Looks like it runs a little bit from the December low into May. Not quite as strong. The 6th year, perhaps the cementing of legacy, keeping energy prices lower and inflation down is a thing. Nat gas, it's been in retreat. We could see some demand pick up as we get into heating season. Usually a seasonal low in February for us. You don't see it on this chart, but you know, we might trade the UNG or the stocks ETF, the FCG. We're going to look for a seasonal low, probably in the next issue or two, coming out in January, maybe early February, depending upon where gas trades. We might look for a couple of stocks too, an MLP or a pipeline, something like that. Seasonally, midterm year, again, not super strong in the 6th year of the presidency. Do get that rally from, there's that sort of February low into the, you know, pre-summer high. So that's a look at the commodity seasonals that we track. We cover in the newsletter, comes out of our old Commodity Traders Almanac. But for now, I just want to run through the offer we have here. Again, limited time seasonal, holiday seasonal offer, best price we ever put out there, $169 for 1 year, $289 for 2, includes the book. You got Santa in the code. You can hit the QR code. So that's the deal, the best one we have. Just a little bit about the letter. We tell you what to buy, when to buy it, at what price, and when to sell. We don't just tell you a stock. We give you a buy limit, stop loss. We change those. Our stock portfolio is up 771% versus 384 for the S&P going back to 2001. You get the free copy of the book. You get our MACD buy and sell signals for the best months of the year, monthly market calendar, vital stats, market at a glance, pulse of the market, all of our time-tested proprietary seasonal strategies that we invented. You get them nowhere else. Our seasonal sector ETF trades, undervalued, off Wall Street's radar stock picks, and then we do a monthly call where we take a whole lot of time to answer questions, usually about a half hour, an hour. I can take a couple at the end here. But so basically, it's for the Almanac Investor Newsletter for fund managers, advisors, and individual investors. As I say, those who understand market history are bound to profit from it. I think we are the authority on seasonal market performance. You know, we help you make better trades, investments. The same patterns happen year in and year out. We send them to you in your inbox. We combine history, market seasonality with fundamentals and technicals, help you make better trades. And us too. So we think that understanding market history can produce some gains like these. These are a few highlights of our ETF strategy. Nice trade in utilities this year. That's a March to October trade. Couple of stock picks that did really well. You can go online, stocktradersalmanac.com, and see a bunch more. So, you know, we also have this free lunch on Wall Street trade that's out there right now. Stocks making new 52-week lows. That's, again, a newsletter feature that we put out over the weekend. Stocks making new 52-week lows last Friday. Trade is still available. Here's the chart of the stock picks versus the S&P and the Russell 2000 going back to 01 through the end of last year. We'll update this shortly. And again, here it is. Happy holidays, happy new year. I wish everyone health and prosperity in 26. And if we'd like, I can take a few questions. I don't know if we got everyone here. Let me pull up my, let's see. There we are. Gonna pop out the questions and I'll see what we got. Let me go back. Let's see. Okay. Oh, Jamie D left. The 3 metrics. Could you clarify what the actual 3 metrics are for the January effect? It's not the January effect. The January effect is the tendency for small caps to outperform large caps in the month of January that we show in the Almanac. Actually begins right now around mid-December. The 3 metrics are the Santa Claus rally, the first 5 days, and the full month January barometer. So let's see. This is from RL or something. Federal budget deficits running at $2 trillion a year. Consumer card debt is $1 trillion. Consumer credit card debt is $1 trillion. Margin debt is also north of $1 trillion. Are you worried about the large debt? Let me just see if I can get to the bottom of this question. Amount loaded on our account. Yeah, I'm worried about it. As everybody is. My understanding of history is that countries tend to inflate themselves out of this kind of debt. I do think we need to clean it up. That's part of the reason why rates have to come down, so we can lower our debt payments, our interest payments. But it's definitely a concern. I'm just not convinced it's going to come home to roost right now. Jeff Rutledge, you're very welcome. Merry Christmas to you. I'm glad Chris was able to help you. All good things. Michael's asking weakness in Q1 26. Our chart, which I didn't really get into today, the weak spot of the 4-year cycle. Again, this is all in the full forecast and also in the Almanac, is Q2 and Q3 of 2026. It sets up the sweet spot of the 4-year cycle, which is from Q4 of the midterm year till Q2 of the pre-election year, where Dow and S&P are up about 20% and NASDAQ's up about 30% from Q4 midterm year to Q2 pre-election year. But the weakness is Q2 and Q3 of 2026, or the midterm year, and you can see it on some of those charts. I guess I could see if I could swing back there for that. Hold on a second. Let me see if I can get back and show you that. There we go. No, not that one. Well, you can see it here, but I wanted to show you this one. Yeah, here's Q2, Q3. You can see the week this year, right? Okay. Joseph is asking, what's your view on rare earth metals, speculative or has some substance? I think it has some substance. I think there's a big run there and a big speculation there. I think it's important for the United States to extract some of that stuff we have here as cleanly and safely as possible. There's some substance, but there was definitely a big speculation trade in there. Michael is asking, if we get a bear market 26, how bad will it be? I mean, a bear market's, 20 to 30%. I mean, how bad is that? It's going to be a bear market. I think, I don't think it's going to be a 50% bear market. I think it'll be more of a garden variety, if that answers your question. Gold skyrocketing equals geopolitical event, war is near. I think we're already in a couple of wars in this world. I think that's part of it. I don't think it's necessarily emblematic of the a new war coming out per se. We've got central banks buying gold. We've got a de-dollarification going on out there. We've got inflation. So I think that's part of what gold. It's also a bit of a making new highs. It's getting some attention. A little speculation there as well. Joseph Largman is asking, when does the upwards inflation trajectory become a concern? Thank you. I think if it gets steeper and goes, further up on a moving average basis, it's still right around 3%. I don't think the trajectory is not there. It would have to be a trajectory. Right now, it's just slightly inching higher. Daniel Goldsmith, can we buy the Almanac without subscribing? Yes, you can buy it everywhere books are sold, or you can give us a call or shoot us an email. We can get you one ourselves. I don't think it's actually easily available to buy just, online by yourself at our website. But go to stocktradersalmanac.com, send us a note, or give us a call. Michael says, are treasury bonds a melting iceberg? I'm not sure what that metaphor means. Treva's asking vertical chart of the 3 months again. Surely, be happy to. Michael, if you want to re-ask your melting iceberg or explain what you mean by that, I'll try to address it. Here's the 3 months. So nobody wants to buy treasuries with USA. Yeah. I mean, I don't know about nobody. I think that's a bit dramatic. They still seem to be selling. We might be a little less favored, but it's still, you know, the U.S. dollar still got some worth out there. So yeah, I think that's why the QE is back in play a little bit. The Fed's got to buy some himself to shore things up. So I'm not sure it's nobody wants to buy treasuries, but they're buying a little less than they are concerned about our debt. I think it's a concern. Though we've had debt issues before, we've inflated our way out of them. We've technologically advanced ourselves out of them. May take some time. I think next year is still going to be pretty solid. After that, you know, we're going to end up having another bear market at some point. I just don't see it lining up for next year, and it would be nice to shore up some of our debt level, but definitely a concern. So I'll give anybody another minute or so since there's a lag to get any questions in, and then we'll wrap it up. Please take your time, take some time out and have a look at our website, stocktradersalmanac.com, and try us out. Get a free book, get some stock picks, ETFs, market timing analysis. You can go to the website, and if you click on one of the recent alerts, you'll be able to take out a free trial for 7 days if you want to kick the tires. But one of the better deals out there. So thank you for coming by, everybody, and I'm going to leave it there. Any other follow-up questions, shoot us an email, give us a call. And again, Merry Christmas, Happy New Year, Happy belated Hanukkah, everybody, and all good things in 26. Thanks very much for joining us. Bye-bye.